Good morning, everyone. Thank you again for joining me for this monthly feedback session on surf portfolios. My name is Eva, and I look after investment consulting at Sygnia Asset Management. What I want to cover this morning is I will look at economics and markets. I will cover that briefly. And then straight after that, I want to show you how your portfolios have performed. I will also show you the performance of the markets, and I'll tie that in together with providing you some high-level attribution. In other words, where did the performance really come from? Then we'll look at portfolio construction, and I want to give you some insight into our portfolio construction process. And then lastly, I'm happy to take some questions live, and whatever questions we don't get to this morning, we will most definitely respond to you on email after this presentation. So looking at economics and markets just broadly, for the last 7 or 8 months, it has been all about this COVID-19 pandemic and how it's affecting, companies and individuals all across the globe. So what we have seen recently is a definite uptick, a second wave, especially in some of the European countries. We've seen some pressure in the UK. We've seen France with curfew, some lockdowns happening in Europe. So again, whenever that happens, the markets become a little bit more concerned, and we've seen a lot more volatility in the markets, especially in September. The positive news is that in general, we're seeing that hospitalization rates are a little bit lower than previously predicted or modeled by a lot of these experts. But with the coronavirus pandemic, one thing that we have learned is that news changes almost on a daily basis, and we actually have also seen even the hospitals becoming slightly under pressure, especially if these European nations don't do anything in terms of restrictions. On the positive front, the vaccine trials are going on, and we're getting closer and closer to actually having a vaccine approved. And I do believe that once that happens, although we know that the vaccine is impossible to be administered to everybody in a short space of time all across the globe, but just the fact that it will be available, Markets don't like uncertainty. Markets respond well to positive news flow, and we think that just the news flow from, vaccine being approved will provide some stability in the markets. So there has been a lot of volatility. We have been speaking about volatility, every month in these sessions, but I will show you again from portfolio construction perspective what we do in order to harness that volatility. In the UK, well, before I get to the UK, I'll first touch on the US. In the US, it's all about the elections at the moment. Trump has been in the news quite a bit. Of course, him and his wife were positive for COVID-19, and he himself has actually been almost brushing off the seriousness of the virus, and that will, to some extent, affect the result of the election as well. As it currently stands, these things are not easy to call, it's not easy to predict, and as much as we can look at the polls, and the polls currently are favoring a Biden victory, but we have been surprised by polls before, so we are still waiting for that 3rd of November election to see what happens. But broadly speaking, why the US elections are important for the rest of the world and South Africa is if Trump wins, we can continue to expect tensions between the US and China. And these tensions are not good for the rest of the globe. They're not good for global trade. So that's why, as much as the election is there, it does affect the rest of the globe as well. And if Biden wins, we can expect a weaker dollar. That's very positive for emerging markets. A weaker dollar is good for emerging markets because about 80% of emerging markets' debt is denominated in US dollars. And of course, if the dollar is strong and the emerging market currencies are weaker, it costs a lot more to pay down your debt. So we're watching this very closely, and we do expect a lot of volatility running up to that election. On the UK front, it's looking like a no-deal Brexit. The Boris Johnson has been, in the news with previously agreed things in the agreement, and now he's trying to contest those. And what that has resulted in is, again, a lot of volatility in the pound. I just saw news flow this morning, they have signed a trade deal with Japan, so they are making some progress, but it's really the trade deal with the Eurozone that seems to be something that they cannot agree on, and it may actually turn out to be a no-deal Brexit. Japan is something that we don't typically always cover in our presentations, but they have had a recent change. There's been a new prime minister. However, the new prime minister has said that he will continue on this three-arrow approach of the previous prime minister. And the three things that they're really focusing on is fiscal policy, monetary policy, and structural reform. Now, Japan, why we focus on Japan is because they're a very good case study for being a country that entered into a high debt and low growth environment, and they started QE back in 1998. And they have really struggled with growth. And if you look at the chart on the top right-hand side, you'll see that the white line is Japan's market, their stock market. So their stock market over this period has grown. However, if you look at the yellow line, which is GDP, you can see it has only grown a little bit, but it has been mostly flat for the last 20 to 23 years. So this high debt environment can be, very scary. This high debt environment really does make it more difficult for countries to grow. Essentially, to put it into simple terms, what happens is when you have very large debt, a lot of the income that governments collect, they unfortunately don't spend that income on growth initiatives, on fixing up infrastructure, on investing into education and healthcare, but instead they have to take this revenue and pay down that debt. And now, especially with the COVID-19 pandemic, a lot of countries across the globe have taken on quite a bit more debt in order to provide these fiscal packages to deal with the coronavirus pandemic and to assist companies and individuals that have been in lockdown and have had their businesses closed, they haven't been working. So these fiscal packages have been great in order to support markets, to support individuals and companies, but unfortunately, those packages have been provided by taking on debt. So we watch Japan closely for that reason. It's a good case study for what may happen in a lot of the world. And then the United States has a new policy framework that will target 2% inflation over time. If you look at the chart at the bottom right-hand side, you'll see that the inflation is quite a bit lower at the moment. And the positive thing is that they have signaled that they will keep interest rates low right through to 2023. And that, again, is positive for emerging markets. And then on the local front, we all know that South Africa has its issues. We have very high debt levels, and the debt levels and structural reform is really the big highlights that we're looking forward to see what Tito Mboweni will address in his medium-term budget policy statement that's scheduled for the 28th of October. If you look at the charts on the top right-hand side, you'll see that South Africa's economy has contracted for 7 of the last 10 quarters. So we don't find ourselves in a good place from a growth perspective. But of course, the coronavirus pandemic does have a big role to play in this, especially in our growth for this year in particularly. In terms of the debt levels, the previous time that Tito Mboweni addressed us was in his supplementary budget speech, and then he spoke about the active and the passive scenario. The active scenario would be if we really make some serious changes and we really do something about these debt levels, we bring the public sector wage bill under control. And if we can follow this active scenario, then yes, our debt levels are high, but over the next few years, we can bring that debt to GDP level under control. Unfortunately, he also painted a very scary picture of a passive scenario. Now, the passive scenario would be if we don't do anything, if government continues with reckless spending, with this public sector wage bill, if they continue with the big increases that they have been giving, then unfortunately we will land up in a scary situation. He mentioned countries such as Argentina and such as Greece. So this really is the key to being able to bring these debt levels under control. Something has to be done and spending has to be more controlled. So we're very much looking forward to that budget speech and to see what the sentiment will be from an investor perspective post the speech. Now, from an investment performance perspective, I've given you now just a brief highlight of the big events happening around the globe. And as I mentioned at the beginning, a lot of the volatility in the market really is around the COVID-19 pandemic and where we find ourselves. So due to these restrictions that have been put in place in the UK and the big surge in infections, investors have become more frightened, if I could say. So we have seen this volatility in the markets, and if you just look at the September column over here, you will see that pretty much across the board, September was a negative month. So our local market didn't do too well in September. We see those negative returns for September for the SWIX, the capped SWIX, as well as our resources in industrials. And looking a little bit further down, we can also see that the global indices also suffered in September. But I'd never like to focus on the short term, especially in the retirement fund investment. We need to focus more on the longer term. In fact, when we're looking at retirement funds performance, we really should be looking at the 5-year, 10-year plus, because members will be invested in these portfolios for a very, very long time. But if we could just focus on the 1 year, of course, we have these updates regularly. So let's just look at the last year. It really has been a year of unprecedented market conditions, and despite that, there has been, places to invest that have provided the portfolio with good returns. So if we focus on the 1 year, what you'll see is that, yes, the JSE SWIX index is down 2.2% for the year, but there has been pockets of opportunities even within the JSE. And if you look at the resources in the industrials, those sectors are actually positive for the year. Looking a little bit further down to the MSCI World indices, you will see that investments outside of South Africa would have helped portfolios a lot. So the global indices, the MSCI World is the index for developed countries, and that has given us 21.6%. The emerging market index has given us 21.7%, and then the all country is made up of developed and emerging market countries, and that gave us 21.6%. What has helped that figure is also the fact that the rand has weakened relative to the US dollar over that period by 10.1%. And you can see that on the second last line on this chart. So broadly speaking, South African equities have not helped much in portfolios. The offshore portion is really where a lot of the performance has come through. So looking at how that translates into the performance of the portfolios, the Signature 70 Fund and the Skeleton 70 Fund have given us 7 and 6.8% respectively over the 1 year. I will also show you the return of the Synergy range as well as the returns of the more conservative portfolios. I'm simply focusing on the Signature and Skeleton 70 funds here is because these are the funds where we fully 100% control the full asset allocation of the funds. So our asset allocation is where the returns have come from. So when you do attribution analysis, we see whether the returns of the portfolio came from asset allocation or whether it came from manager or strategy selection. Now, when we ran the numbers, it's very clear to see that it's the asset allocation that helped the performance of these portfolios. And if you look at specifically which asset classes have actually helped the performance, it has been the offshore portion has made the biggest difference to your portfolios, followed by our income, followed by our investments in bonds. So this is just at a high level. If I could just flip back to the market slide, of course, we do invest in the markets. We do have a blend of active and passive management in the signature range and a fully passive portfolio in the skeleton range. But essentially, we do invest in the markets. So it's good to look at the market slide and then how these market returns translate into your portfolios. So bearing in mind that the market has been down for the 1 year and our biggest proportion of our investments are in South Africa, we're very proud of this performance of 7% for the signature range and 6.8% for the skeleton 70 portfolio. It's always good to look at performance over the long term as well. And as I mentioned in most of my presentations, I like to show this chart because it also shows us that yes, there is growth in your investments, but it no means a smooth journey. You can expect volatility along the way. We do invest in markets. Markets are influenced by news flow. They influenced by the exchange rate, and we know that investing in shares, in property, in more of your riskier asset classes is not a smooth journey, but investors are rewarded for that risk over the long term. So focusing on the red line, which is the signature range, we can see that relative to competitors as well as relative to the Sygnia and the skeleton range over the long term, this portfolio has done phenomenally well. The Sygnia and the skeleton range have also been included in the blue line, so you can see that also tracking the rest of the portfolios quite nicely. And then all of the grey lines that we have included there, each line is a representation of the performance of the managers that I've listed at the bottom of this slide. And the median performance of those managers is the black line, which is the Global Large Manager Watch median. Now, the Global Large Manager Watch median is a very well accepted benchmark in the retirement fund space. And if you can beat this median manager performance, then your portfolio has done very well. So we're very proud of the performance of all three of our more aggressive portfolios, the 70 portfolios. From an asset allocation perspective, which is really where a lot of our performance has come from, it's getting that asset allocation call right. All of the portfolios have been structured in a way to have a similar asset allocation. And in fact, the asset allocation of the signature and the skeleton range is, as I mentioned a little bit earlier, 100% controlled by our investment team. But the Sygnia range, because the local portion of the Sygnia range has been outsourced to South African balance managers, and I'll show you which managers those are a little bit later on, they control the local asset allocation and we control the global asset allocation. But you can see that, of course, the 70 portfolios have a higher allocation to local and global equities. And then, of course, the 50 and the 40 portfolios that are suitable for older members closer to retirement have a smaller allocation to equities and a larger allocation to your bonds, your income, and your money markets. And this has really been designed in order to protect those older members that are closer to retirement from market volatility just before they retire. In the signature range, as I mentioned, the signature portfolio range is a blend of both active and passive management. So if we look at the equity portion of the portfolio, a big portion is in the Sygnia Swix Tracker, which is passive, but then we do have the active managers that have been included in the portfolio to add some diversification. They've been chosen in such a way that they think differently, they have a different philosophy and process, and they add that extra opportunity to outperform in the portfolio. Likewise, in the bond space, it's a mixture of active and passive management, and then on the offshore side, it's all passively managed strategies other than the Sygnia International ESG portfolio, which is our investment in the Oxford Sciences Innovation Fund. In the skeleton range, exactly the same asset allocation, but in order to keep costs really low in this portfolio, we are only making use of passive strategies. So you will see that for every building block, we make use of only passive strategies. And then the synergy range, as I mentioned, it is a mix between local managers, but then the offshore portion is exactly the same across all of our ranges. So the offshore portion of the synergy, the skeleton, and the signature range is exactly the same. On the local side, we have a mix between Allan Gray, Coronation, 91, and Prudential. For some of you that may not know, 91 is Investec Asset Management. They have rebranded, so they do have their experience, their long-term track record. They have just simply rebranded and now call themselves 91. From a survey perspective, Alexander Forbes prepares these surveys. They compare like-for-like portfolios. So what we're comparing over here is all of the portfolios that are in the low equity multi-manager survey. So all of these portfolio are low equity in terms of construct. They all have roughly 40% allocation to equity. That's why we are comparing our 40 portfolios over here. Now, what's important to mention is that these surveys are independently prepared. They are prepared by Alexander Forbes Investments. What asset managers and single managers do is they provide their performance numbers to Alexander Forbes, who then verify it on their side, and they bucket the like-for-like portfolios, and then they produce these surveys on a monthly basis. And what we can see is that over the 1 year, the skeleton 40 portfolio has been the best performing portfolio relative to all of their competitors. What's quite interesting, even in this low equity space where you would expect a little bit less volatility because it's mostly, these portfolios mostly have investments in safer asset classes, you wouldn't expect such a big dispersion in returns. And if you look at the top performing portfolio, which is the skeleton 40, giving you 7.4% for the 1 year, and you look at the worst performing portfolio, which in this instance is the momentum enhanced 4, there's quite a big dispersion. We don't often see this big dispersion, but it has been, as I have mentioned a few times, quite an unprecedented market environment. And if portfolios were invested in the wrong asset classes, then the return profile that we have seen for some portfolio has been quite extreme. And then again, focusing on the longer term, we can see that the Skeleton 40 Fund is the best performing manager over 3 years, and then the Sygnia, Skeleton, Synergy, and Signature portfolios are just slightly behind Old Mutual and Alexander Forbes Investments over the 5 years. As I mentioned a bit earlier, always important to look at performance over the long term. What's important in a retirement fund portfolio is consistency. You will be invested in these portfolios for the very long term. So this consistent return and being able to provide good performance across very long periods of time is important. So looking at the 7 and 10 years, again, these portfolios have done really, really well. And over the 10 years, the best performing portfolio has been the Signature 40 portfolio. And the return of 10.9% for the Signature 40 portfolio is annualized, meaning that over the last 10 years, had you been invested in this portfolio, you would have enjoyed the return of 10.9% per year for the last 10 years. Similarly, we have a survey for the 50 portfolios. So again, these are compared to very similar portfolios that have about 50% allocation in equities. And you can again see that these life stage portfolios have been the top performing over 1, 3, and 5 years. And again, more importantly, over 7 and 10 years. I have a same survey for the Signature, Skeleton, and Synergy 60 portfolios. And again, very proud of the top performance across all periods. And most importantly is the 70 portfolio. Most members do default into the life stage portfolio, and according to their age, they will be invested in these portfolios right up until 6 years before retirement if they don't make an active investment choice to switch out of these portfolios. So what we do find is that members do spend the majority of their working lives in the default life stage portfolios. And if they have to default into the life stage, they would be invested in the 70 portfolios for the longest period of time. That's why it's always important to focus on the 70 portfolios. And again, if we look at the performance over 1 year, the Signature 70 portfolio has been the best performing portfolio out of everybody in that survey. And again, I want to highlight this big dispersion. There's a dispersion of 11% between the best performing and the worst performing retirement fund portfolio in this survey. Over 3 years, the Skeleton Fund is actually ahead of the Signature Fund, just by a couple of basis points. And then over 5 years, it has actually been the Synergy Fund that has performed the best relative to peers. Focusing again over the longer term, we can see that the Signature 70 Fund has been the best performing manager in this survey, and giving us 11.8% per year for the last 10 years. You'll also notice that there's less competitors in the space when we look at 7 and 10 years. That is because not everybody has a 10-year track record. So if you don't have a real track record, you cannot be included in these surveys. And always interesting to look at performance relative to single managers. We know with single managers, we can never expect one single manager to outperform across all time periods. The reason for that is that typically single managers have much stronger views, more high conviction, concentrated portfolios. And for that reason, not every market cycle and market environment is conducive for them to be able to outperform. Some, value managers have a certain time and certain market conditions where they outperform. Growth managers perform in a different market cycle. So we do find that single manager performance does vary across all periods, and that's very evident in these charts. So over the 1 year, we can see that Foord has been the best performing retirement fund portfolio. They would have given you a 9% return over the last year to end of September. Now, Foord has been quite negative on South African stocks, so they have avoided being heavily invested in the South African market. And if you think back to the market slides that I showed you a little bit earlier, yes, the market is down 2.2% for the year. So by them being underweight the South African market, they've actually done well. So they've maximized their offshore allocations, just like we have in your portfolios. And that offshore portion really has helped. And in addition to that, they have also been investing in gold, and gold has been doing really, really well. When investors become nervous about everything that's going on in the market, typically they run to invest in gold. The reason being is that when there's uncertainty and you're not quite sure which stocks will outperform well, and as we saw earlier on in the year with lockdowns and even very, very good businesses, unfortunately, even if they were profitable, depending on what industry they were in, they had to close. And of course, that does affect their earnings. And when investors are simply unsure where to put their money, gold has always been seen as a good place to invest, as it's an actual precious metal. It's got value in itself. And that's the reason why it has done well. And of course, the investment into gold has helped them. Our Signature Fund, the 7% that I showed you over the 1 year a little bit earlier, and the 6.8 for the skeleton range, those are then the next best performing portfolios over the 1 year. Over the 3 years, you can see that our portfolio is just a few basis points behind the standard portfolio. And over 5 years, the Synergy 70 portfolio has been the best performing. Importantly, again, over the 7 and 10 years, it has been the Signature range that has been the best performing portfolio against single managers and against multi-managers. Always important to look at the risk that portfolios take on as well. So from a risk and return perspective, what you wouldn't want is a portfolio that takes on a lot of risk. So a portfolio that invests in a lot of risky asset classes. So your risky asset classes are really equities, local and global, property, local and global, alternative investments such as private equity, investment into hedge funds. All of these asset classes do add more risk to your portfolio, because there is a higher risk that if you invest in a certain company, that company might not necessarily grow, and you may actually lose some money. You may experience a negative return out of the more risky asset classes. But broadly speaking, the higher the risk of the portfolio, the higher the return will be over the long term. So if you look at risk on the horizontal axis, the further right you look, the more risk a portfolio is taking on. And then if you look at the returns are on the vertical axis. And ideally, in a dream world, we would have portfolios that take on very low amounts of risk, but they perform really, really well. But unfortunately, you have to take on some risk to enjoy high returns over the longer term. So the way to look at this is for every level of risk, you want the top performing portfolio. So if we focus on the Signature 70 fund, we saw from the surveys that this portfolio over the long term has been the best performing portfolio relative to both single managers and the multi-managed peers. So we can see that this portfolio taken on just below 9% of return, but has provided 9% of risk, but has provided you the highest return for that level of risk. All of the portfolios under the Signature 70 fund, so if you look at Coronation, Momentum Flexible 6, even Alexander Forbes Performer, Sanlam MM60, all of those portfolios have taken on the same risk, but they simply haven't delivered the return. What's even more extreme is the portfolios further right. So looking at Sanlam MM70, Momentum Enhanced 7, Momentum Classic 7, you can see that they are further right on the chart, meaning they've taken on a lot more risk, but looking at their corresponding return on the vertical axis, they simply have not delivered the return. So from a risk and return perspective, really great risk return metrics for all of the portfolios, the Signature, Skeleton, and Synergy portfolios. Now, today's session is focusing on portfolio construction. So I wanted to give you an insight into how we think about the portfolios, how we think about the construct, and how we go about actually creating these portfolios that have performed really, really well, as you could see in the surveys. Now, I'm not going to spend too much time on this, but just a reminder that the default portfolios that members will be invested in, if they follow the life stage, will be the Skeleton, Signature, and Synergy range. And of course, we do have member investment choice options where members can switch out into the single manager portfolios. And the de-risking of the life stage model starts 6 years prior to retirement. I'll touch on this very quickly. I have spoken about this before in the previous webinar, but for some of you that would have missed it, the big difference between the Skeleton and Signature range, the difference between those portfolios and the Synergy range is really from a construction perspective, whether you invest in a specialist or a balanced manner. So with the Skeleton and the Signature range, I have mentioned a little bit earlier on that we fully control the asset allocation of the portfolio. So what we do is, let's say the 70 portfolio, we take that 70 portfolio and we first decide where it needs to be invested from an asset allocation perspective. So we'll make decisions on the correct amount to be allocated to equities, the right amount to bonds, the right amount to cash, to property, to offshore. So we look at all of the asset classes and say, for example, it needs to have about 48% in equities. Within the equity space, then we will decide which managers or strategies we actually want to use to implement on that decision. So in the Skeleton range, we only use indices, and of course in the Signature range, we use a blend of passive and active management. But the point being is you decide on the asset allocation first, and then you manage your strategy selection. In the Synergy range, however, in the local portion, so the 70% that's invested in South Africa, we had divided that up between single managers, and I showed you the manager lineup there. And each manager then has discretion to decide whether they want to be a little bit overweight equities, a little bit underweight properties, depending on their views. So that's what we call the balanced approach. For our Signature and Skeleton portfolios, we follow a core satellite approach to investing. Now, what that means is we want the core of the portfolio to be passive. And this is really to keep costs low. There's also an argument to be made about market efficiency. But the core of the portfolio, so the big bulk of it will be passive. as I mentioned, when you keep costs low, it's also a benefit for members, because members, the physical experience that they enjoy from these portfolios is actually the net of fee experience. So keeping costs low is very, very important to us. But in addition to this core passive that we have in the portfolios, we also look at broad themes in the markets, and that's where you see these 5 satellites that I've shown you. Now, the only satellite that's on the local side is this credit and infrastructure, which I'll talk to about. So some of the themes that we have made investments into, I want to touch on. We were previously very much underweight global property, and due to the very low valuations and the price that we were able to buy in, we have gone slightly underweight this global property. But it's important that the specific index that we're following over here doesn't have any exposure to hotels, resorts, a lot of the leisure, a lot of these sectors in the property market that have really struggled through this pandemic. So a lot of the investments here are into, cell phone towers, that type of property. So we do think that it's a good position, it's a defensive position in a way, and we have also bought into this position at a very good price. Technology has been a theme in our portfolios for quite a while. We have sold out of the FANG stocks, but we do have investments into the Fourth Industrial Revolution Fund, and the Fourth Industrial Revolution Fund actually did really well and held up really well in September, when the rest of the markets were volatile and the rest of the markets actually gave us negative return. So technology, good theme in the portfolio, and that's one of the satellites. Emerging markets is more of a longer term story. Emerging markets are more volatile than the developed world, and we can expect emerging markets to recover from this pandemic later than the developed market countries. Other than China, China's growth has been holding up even through this pandemic. But broadly speaking, with emerging markets, we are specifically focusing on the Asian economies, these Asian economies that have a rising middle class. So that's a good theme in the portfolio for us. Healthcare has been something that we've been focusing on for quite a while. You would know that we have this very exciting investment in our portfolios into the Oxford Sciences Innovation Fund. We have also recently launched the Health Innovation Fund. So health, broadly speaking, is a really exciting theme. So that's one of the satellites in the portfolio. And health, again, can be viewed as a very defensive satellite in the portfolio. Reason being is at the moment it's doing well due to all the focus on vaccine and treatment developments. But even post the pandemic, healthcare is something that governments need to be spending more money on and focusing more on, and we're starting to see a bigger focus on healthcare, and it really is because we are seeing aging populations across the world. So we do think that health will be a big theme over the long term. And then locally, we have credit in our portfolios, and of course, if government, as they have signaled, do make changes to Regulation 28 for us to invest into these infrastructure projects, that will be another satellite into the portfolio. So broadly speaking, as I mentioned again, we have this core satellite approach. So the core of the portfolio has to be a low cost, but be able to track the markets really well. That's why we use the passive core, and these themes that we see in the portfolios will change from time to time, but these satellites are really what is adding that sweetening to the alpha, adding extra return to your outperformance. And a lot of these satellites are also seen as defensive in the portfolio. We do then have 2 overlays. The one is our tactical asset allocation overlay, and you'll know that as much as we decide upfront what our portfolio strategic asset allocation will be, we do make changes to that asset allocation depending on the current market environment. So that's our tactical asset allocation overlay. And then we do have ESG, so our focus on environmental, social, and governance factors. We do think about ESG throughout our portfolio construction process. So if we look at the asset allocation of the portfolios, this is where that tactical asset allocation comes in. So as I mentioned, we decide on the strategic asset allocation of the portfolios when we're creating the portfolios, and that's really where the portfolio needs to be over the long term. But over the short term, depending on the market environment that we're experiencing, we do make these tactical changes. So if we look at, these are for the Signature and Skeleton 70 fund. If we look at South African equities, the long-term model says that we should have 48% in equities, but we are underweight. So we've got a 46% investment in South African equities. In the bond space, we have gone overweight, so we've got a 15.5% allocation instead of 13%. In the income and money market space, you can see that we're underweight there as well. This really is due to the low interest rates. You'll know that South Africa has cut interest rates quite aggressively, and of course investing in money market is linked to the interest rate, so those asset classes have become less attractive to us, and that's why we've gone underweight. Global equity, we are maximizing that exposure. The regulations, the Regulation 28 of the Pension Funds Act only allows us to take 30% offshore. So you can see that we have maximized that offshore exposure. It does add diversification to your portfolio. It does protect the portfolio should the rand weaken. And as I showed you in the performance of your portfolio, the biggest contributor to those good returns has been this offshore allocation. Global bonds, because interest rates are basically at zero in the developed world, global bonds is not an attractive investment, and that's why, as much as the model has been designed to have about a 4% allocation to global bonds over the long term, at the moment we have a 0 allocation to global bonds. And global cash, we're slightly underweight there as well. Now, in the Signature 70 fund, we use, as I mentioned a bit earlier, an active and passive blend to implement on these portfolios. So this is the manager line. And in the Skeleton fund, all passive indices. And lastly, the Synergy 70 fund has an allocation to Allan Gray, 91, Prudential, Sygnia is the offshore portion, and Coronation. So thank you very much for listening to my presentation, and I will be happy to take any questions. There's a question. If returns have largely been driven by asset allocation, and we see the Synergy ranges underperforming the Skeleton and the Signature range, how are the underlying active managers in Synergy positioned relative to Sygnia's views? So one of the big differences between the way we have positioned our local portion of the portfolio, because of course the global portion of all three ranges is exactly the same, we have been avoiding local property. And if you looked at the market slide, property is down excess of 40% over the year. Now, property in South Africa has been an asset class that was not doing well even pre-pandemic. And now with the pandemic and a lot of people working from home, and even though interest rates have been lowered, we have seen a slight uptick on the residential side, but broadly speaking, property investments are very much focused also on, retail space and office space, and we have seen some struggles in those property counters. So by Sygnia portfolios avoiding properties, we have avoided investments in an asset class that has performed negatively, where some of the managers in the Synergy range have had a higher allocation to property, and that's why their returns have been lower. That's just broadly speaking. Our allocation to South African bonds has also helped in the portfolios. So if we had a higher allocation to bonds in the signature and skeleton range relative to the synergy range, that has also helped over that 1 year. And then, of course, we have also seen that stock selection with the active managers has not necessarily done very well over this time. And in fact, in March, when we saw all-time lows in the markets, you know, the JSE was down, all asset managers were struggling. I mean, our portfolios did follow the market as well, but interestingly enough, the passive portfolios did hold up against single managers, even in down markets, whereas from, you know, a theory perspective, a lot of active asset managers will say that when the markets are doing well, they can track the market and even outperform the market. But even more importantly, they say that in down markets, because of their stock selection and they really know what they're investing in, they, you know, they research the fundamentals of stocks, they meet with management, etc., that they can really protect you on the downside. But unfortunately, that was not the experience that we saw from active asset managers in March specifically of this year. If anybody has any further questions, please do email us. We will respond to you, and please send us any feedback that you may have as to what you would like to see in future sessions, and we will consider that as well. But thank you very much for listening to me this morning, and I look forward to chatting to you again and providing you an update on performance again next month. Thank you.